Hi, it's Dawn Connors at Mortgage One, and today we're talking about 5 mistakes that home buyers make when buying a home, things you definitely want to avoid. So before I get started, please like, share, and subscribe to my YouTube channel. I put out mortgage videos weekly so that you know what is going on in the mortgage industry. All right, let's get started. Number 1, do not stop paying your bills. Oftentimes or sometimes a person could stop paying their bills because they want to save more money for the down payment. So they stop making their rent payment or stop making their credit card or car note payment. Doing so will have detrimental consequences. Yeah, like if you stop paying your auto payment or even a small little credit card and it goes 30 days late, that could result in you not getting your home loan, because at any point during the mortgage process, the lender has the ability to do a refresh credit report, a new credit pull altogether, or what it's called a soft credit pull. And a lot of times those things will pop up if they have been done. So you do not want to stop paying your payments. You want to pay them as you ordinarily will. Just a little caveat, if things is a week late, if things are a week late or 2 weeks late, that will not show up. It's things that are 30 days or more behind. And did you know a 30 or 60-day late payment can drop your score by 30 to 60 points? Yeah, one late payment, detrimental for sure. Number 2, you do not want to submit old pay stubs to your mortgage company when you have quit your job or you have started a new job elsewhere, figuring it's just easier to use those pay stubs and the lender won't ask for new pay stubs up until the closing. That is not true. The truth is that a mortgage company has to do a verbal verification of employment and or written 10 days before closing, and sometimes that's as soon as 5 days before closing, and some lender requirements want it 72 hours before closing. Yikes. So do not quit your job or change jobs without telling your loan officer, without telling your lender, so that you can figure out what the adjustments are and need to be. Number 3, you do not want to become self-employed during this process. So you do not want to quit your W-2 wage earner job and take a job that is working for yourself or getting a 1099 income if you haven't otherwise been already receiving that income for 2 years or more and are already self-employed at the pre-approval process. Because you're pre-approved does not mean that you're approved and clear to close. That's the different processes. There's pre-approval, which means that you are approved to buy a home. Then there's the approval process where you go through underwriting and get a sign-off from the underwriter. And then there's the magic words clear to close, which means you can schedule your closing and close. Up until that point, there's all kinds of things that could make you become disqualified to buy. So that's what we want to avoid. The 4th thing is, within being self-employed also, if you change your job, the key is, what does that new job look like? Is it now part-time? Is it now temporary employment? I recently had a client that went and had a new position, a new job, and it was working for a temp service, and the job was not permanent in nature. It was a contract for 3 months. It was making a lot more money, but because it was temporary until they became an employee of that company, we had to put their pre-approval on hold, and that was a 3 to 6 month delay. They're on hold right now, waiting for that job to become permanent. Where their previous job they had was permanent, and they could have closed on their home and then transferred into this job after the closing. So the 4th thing is, you want to avoid large purchases during your mortgage process. What is a large purchase? So that depends on your income. But I would say it's okay to do normal course of business, charge your credit cards like you normally would, like groceries, gas, buying little things here and there. But a large purchase would be, I would think, a furniture or an automobile, something that is over 20% of your monthly income that you are purchasing on credit. You definitely want to avoid that. That causes spikes in your debt ratios, and what happens is we have to do what's called a soft credit pull right before closing, and we will see those spikes and any inquiries on your credit from new credit. And then the last thing that you want to avoid when buying a home is making large deposits into your bank account. You want to stay away from that because basically a mortgage company, a lender, a bank has to track all the deposits that go into your account. And many of those large deposits are non-allowable deposits. So before you make any large deposits, even if it's a gift, talk to your lender and make sure you have the necessary documentation before putting that money in. So stay away from any large deposits. I would say in excess of $1,000. So this is Dawn Connors at Mortgage One, providing fantastic mortgage solutions and looking forward to hearing from you on your questions and your needs regarding home ownership. Thanks for watching.